Hello everybody, welcome to this video on stock options. My name is Mark. This video I'm going to talk about how to read the option chain, and this is a good video to do. I think this should be kind of a short video because reading an option chain is very simple to do, and it's not that hard to understand once you get the hang of it. And so I'm very happy to have a chance to do a video on this subject. Now, if you want to buy a stock, let's say you want to buy Amazon, you just put this symbol in. This is TD Ameritrade. You just pull up the stock symbol and voila, there it is. And you see there's a buy button and a sell button. And you just click on the buy button and you put in your order, 100 shares, and click the review order, and then you're ready to go. Okay. Oops, I put in 1,000 shares. That would have cost me $942,000. But anyways, it's very simple to buy and sell stock. But to buy and sell stock options, you have to go to the option chain, which is right there. Again, this is TD Ameritrade, but all brokers are going to be very similar. So when you want to buy and sell stock options, all stock options have an option chain. And if you pull up a stock and you don't see this option chain, then that means that stock does not have stock options to buy or sell. And if you want to buy and sell stock options, you better find another stock to invest in. But this stock, Amazon, has lots of stock options. So let's go to the option chain, and here you go. So the first thing you see is you see all of these different dates. You see at the top is May 12th. Today is May the 8th, 2017, and this May 12th is 4 days from now, and that means that all the stock options expire 4 days from now. And just a little footnote here, all stock options expire on Friday unless there's a holiday and the market is closed on Friday. Then it would expire on Thursday, or whatever is the last day of the trading week, the last business day of the week. But usually the last day of the week is Friday, and so all stock options are generally going to expire on a Friday. And so you see all of these different dates here, and the short-term ones, the near-term, are at the top, and way at the bottom are stock options that expire 620 days now. It's almost 2 years from now. And the rule of thumb is that the stock options that expire close are generally very cheap. And here you can see you can buy stock. As a matter of fact, I'm going to do a different stock. I'm going to do Bank of America, because Amazon is a very expensive stock and their stock options are expensive. So I'm going to do a cheap stock. Bank of America is a nice cheap stock. So again, going to pull up the option chain here, and here you go. So 4 days. Now we're talking, okay? You can buy a call option for all of $18, okay? And actually, all you can see over here on the left are calls, and over here on the right are puts. Okay, the calls, those are the contracts to buy 100 shares of that stock, and the puts are contracts to sell 100 shares of that stock. And if you think Bank of America is going to go up, you're going to look at the calls. If you think Bank of America is going to go down, then you would want to buy some put options. Okay, so let's look at the calls here. And again, these are the near-term ones. So if you wanted to, here's a stock. You could buy this $24 stock option for all of $18. Now, you could buy this stock option for $3, okay, $24.50. And so for all of $3, you can own a stock option that gives you the right to buy 100 shares of Bank of America at $24.50. Now that sounds really tempting, okay, but keep in mind, what does Bank of America need to do in order for you to make money? Bank of America would have to go up to $24.53. If it doesn't go up there, if Bank of America closes at $24.49, then you lose all $3. Now, maybe that's not a lot of money, but let's say you're high roller man and you have $1,000 and you decide to buy a whole boatload of call options. How many call options could you get $3 divided into $1,000? Quite a few. 333. That would be tempting, but keep in mind that if you did that, if you put $1,000 in there, and then let's say Bank of America went up $1, let's say it went up to $25, then those call options are going to be worth 50 cents, and you're going to have 333 contracts. So 333 times 50, wow, you'd have $15,000. Your $1,000 would turn into over $15,000, right? But if you're wrong, you would lose the whole $1,000. If Bank of America traded below $24.50 on the day that it expired, then you would lose the whole bang. But you know, everybody has their own way, and you got high rollers, and then you got more conservative people. But anyways, so $3 there, right? And here $24. This call option for $24 only costs you $18. So again, calls are on the left. Now, if you thought that Bank of America was going to go down, well, you can get this put option, and it would cost you all $6. Okay, and if Bank of America went down to $23.50 minus the $6, which would be $23.44, you'd start to make money. And so it can be really tempting to buy these short-term stock options, right? Because you can make a lot of money, but if you're wrong, then you're going to lose all your $6, okay? And that's one of the differences between stock options and stock. With stock, you can buy the stock and you can hold it as long as the company doesn't go bankrupt. But with the stock option, your time clock is ticking, and once the clock runs out, then you lose. And the reason is because it's a contract. Okay, that's the difference between a contract and a share. So with stock options, you're buying contracts. Okay, so call options are on the left, put options are on the right. And these prices right here, let me back up. So those are the 4-day options. Now, let's look at this $24 call option. Okay, you can see it costs $18, but if I go another week out, 11 days, the price goes up to $30. And if I go another week out, 18 days to expiration, then it goes up to $39. And if I go all the way out to 620 days, now they don't even have the 24. You got to buy a $25, and that would cost you $270. Okay, and so the rule of thumb is that the longer time is left on the option or on the contract, the more money it's going to cost to buy the contract. And the reason is the same reason why it's more expensive to buy, let's say, life insurance that's good for 15 years versus life insurance that's only good for 10 years. Okay, because there's a greater chance that you're going to die in 15 years than it is you're going to die in 10 years. And you know, with stock options, there is a greater chance that the option will expire out of the money versus in 11 days versus expiring out of the money in 620 days. And that's the next point I want to go over. Okay, so the first point is that I'll go back here, pull up the option chain, and the first thing you look at are the different dates. So you pick a date, and just remember that the closer dates are cheap, the longer dates are expensive, and all the ones in between are in between prices. So let's go out to 39 days. And the next thing you'll notice is that these contracts up here, let's see if I can, there we go. Those contracts up there have a pink or a colored, it looks like pink. It has a kind of a darker shaded area, and the ones down here, the background is all white. Let's see if I can blue those out. All those options are shaded in white, and the reason is because the options below, Bank of America is trading at $23.94. Okay, so the $24 calls and below are all considered to be out of the money, and the $23 and above here are all considered to be in the money. So a stock option that is in the money means it has a real value, and the term is called intrinsic value. So if in 39 days from now, Bank of America were to close at its current price, which is $23.94, this call option will be worth, this $23 call option will be worth 94 cents. Okay, this call option will be worth $1.94, and this one will be worth $2.94. Okay, so you can see that the price changes and it gets more expensive the more deeper in the money you go, and it gets cheaper and cheaper the more out of the money that you go. And so when you buy a call option that's out of the money on the day that it expires, it's going to be worth $0. So all of the money that you're spending for this option is just for the time. You're just paying for time. But this stock option, there is actual value to it. And right now, the actual value, also called the intrinsic value, is $23.94 minus 23. So it would be worth, there you go. It would be worth 94 cents. And so the $1.24 that you're paying an extra 30 cents for that option. And the next point is that all stock options are for 100 shares per contract. So when you buy the stock option here, and I'll show you what I mean. I'll click on this, and I'm going to put the bid price in. So I'll put one contract here, and I'll put in buy to open, and then I'll click review order. You're not spending $1.24, you're spending $124, and I'm not going to buy it. But the reason for that is because all stock options are contracts for 100 shares per contract. So this says $1.24, and this says $2.07. So this option would cost you $207. Because the call option is good for 100 shares. So if you were to actually use your stock option to buy Bank of America at $22 per share, then it would cost you $207 for that option. Okay, so I'm sorry, I kind of flubbed there. That $22, you would be buying 100 shares of Bank of America at $22 a share. So anyways, I hope you understand me. I'm kind of rambling on here and getting off subject and everything, but hopefully you can keep up with me here. Just remember that stock options are good for 100 shares per contract. So when you are buying or selling an option, you have to multiply that price by 100, and this price is called the premium. This is called the strike price. Okay, $23 means $23 per share. $24 means $24 per share. That's the price that you would buy or sell if you're doing puts. Those are that's your selling contracts. But the strike price is the price that you buy or sell the stock at if you were to use your option to buy or sell. Okay, and then the underlying stock value is up here. Looks like Bank of America went up a couple dollars. Now it's worth $23.96. Okay, and again, at the top are all of your in-the-money options. And remember the term intrinsic value. It means these options have real value, whereas these ones, you're spending like if you wanted to buy a call option for $25 strike price, the $24 or $25 that you're spending, none of that is in real value or intrinsic value. All of that goes to extra time, and the time would be 39 cents. So you're literally just paying for time. The option itself has no value. Now, if the price of Bank of America went above $25, then this option would start to be worth money. And if Bank of America went up to $26, then this $25 call option would be worth $1. And again, you multiply that by 100, so it'd be worth $100, and that would be very good, right? You'd spend $24, and if Bank of America went up to $26 in the next 39 days, your $24 investment would turn into $75, right? Minus commission, of course, but that's still pretty good, right? And so that's what stock options do, is they give you leverage and you can make very good money on the stock options. So again, starting over, you want to buy some stock options. So first thing you do is you go to the option chain and then you pick a date. And the general rule is the short-term options are cheap and the long-term options are more expensive. And so maybe you want to do a middle-term one, right? And so you click on the 39 days one, and then you want to pick an option. And all of these options are for different strike prices. Now, one of the things you can do up here, oops, there, okay, is you can put near the money, and those are options near the money. And if you want to just list the in the money options, then you click in the money, and then you click view the chain, and then it only pulls up the in the monies. And you'll notice that the shade is all colored. There's no white shade. And because Bank of America is at $23.96, it's not showing any stock options that are $24, $25 or higher. It's only showing in the monies, and those are, and in the case of call options, in the money call options are lower than the price of the stock. In the money put options are higher than the price of the stock, because if you were to, let's say, buy a $25 call option, a $25 put option, the actual value would be the $25 minus $23.96 would be $104, and you can see the premium is $33.34, so you're spending about an extra $30 to buy this put option. All the rest of it is real value or intrinsic value. Okay, now if you wanted to look at out of the monies, you click on out of the monies, and then it would do it the other way around, and you can see everything is white because it's all out of the monies. And here you go over here, you see the $29 call, you could spend $1, one measly dollar. And so if you had $1,000, you could buy 1,000 call options for $1, okay? But what are the chances that the price of Bank of America is going to go to $29 or higher in the next 39 days? That would be a huge move. That's like a 20% upside, right? But if you think this is your lucky day, then go ahead, spend that dollar and buy those 1,000 call options. Because if it did go higher than that, let's say it went to $30, then your $29 call options will be worth $1. And what's $1 times 1,000? Well, you would be a very rich man. That's $1 is $100. So 1,000 times 100 would be what? 10. You'd have $100,000. Okay. But if you're wrong, then you just lose $1,000, and the chances are pretty low that it's going to go up that high. And there's actually a way that you can calculate the probability using a option Greek known as delta, which maybe I'll do a video on that later on. But for now, I'm just showing you the option chain. So again, starting over, first click on an option chain, and then click on a time frame that you want to buy and sell options. So we'll do 39 days, and then you want to pick an option that you think that Bank of America might hit in the next 39 days. And if you think it's going to go up, and what price do you think it's going to go up to, then you will select that option. Okay, and so you always want to add the premium to the strike price. So in the case of this $23 call, the premium is $1.24. So 23 plus 124 is $24.24. So in order to make money on that call option, Bank of America has to go up to $24.24 or higher. Okay, if you went further in the money and you bought a $22 call option, 22 plus $2.07 is $24.07. So you can see the further that you go in the money, the less the price of Bank of America actually has to move in order for you to make money. But also the greater is your downside risk, because here, if you bought this $24 call, Bank of America would have to go all the way up to $24.62. If you bought this $25 call, and you would only have to spend $24. And then if Bank of America went up to $25.24, you start to make money. But if you're wrong, you only lose $24. So there's a pro and a con to buying the out-of-the-money calls versus the in-the-money calls. Okay, if you bought the in-the-money calls, like let's say this one, and you were able to get this $21 call for $2.98, Bank of America only has to go to $23.98. That's only 3 cents away, and you start to make money right away. But the downside is, if Bank of America goes down, you could lose $298 versus only losing $24. So the upside of buying a call option is that they're very cheap and you're not risking a lot of money. The downside is that it can be very difficult to make money, because what are the chances that Bank of America will go up to $25.24 or higher? Okay. And on the flip side, the benefit of buying a call option is that Bank of America only has to move 3 measly cents for you to make money, but you're risking more money. So you just got to kind of pick and choose based on how much money you're going to risk, your risk-reward ratios, and all of that good risk management stuff that hopefully you're learning about as you become an investor. Okay, so that's a basic rundown of how to read a stock option. So again, going back to start, you want to buy a stock option. So if you want to buy a stock, you just click on the buy button and you put in all the info, right? But if you want to buy an option, click on the option chain, pick a time length, and then pick the price of stock option that you want to buy or sell based on what price do you think Bank of America is going to go to. If you think Bank of America is going to go down, then you might want to buy, let's say, this $25 put option. And this $25 put option, it looks like it's going for $132 a contract. So 25 minus the $1.32 would be $23.68. So if Bank of America went to $23.68, that's about a 30-cent drop or lower, then you start to make money. Okay, but you are risking $132. Now, if you bought the $24 put option, now you're only risking $70, but Bank of America would have to go all the way down to $23.30 in the next 39 days for you to make money. So those are all the things that you need to weigh out when you choose options. Okay, number one, how much money do you want to risk? Number two, what is the chance or probability that the stock price of Bank of America is going to hit that price? And right now, Bank of America seems to be going up. So maybe you want to stick with the call option. So those are all decisions you have to make, but that's a general idea about how to read an option chain. And then when you're ready to buy the stock option or whatever you want to do, then you just click on that. Then you just click on that price. So you would, in the case of the put, this $25 put, oops, just one, you click on that and then it pulls it up and then you put it all in. If you want to be the buyer, the option buyer, you click buy to open, put in your one contract or whatever, and then click review order, and there you go. It's going to cost you $133. Okay, so that is it for this video. Hopefully I did a good enough job of explaining the option chain and how to read the option chain. Hopefully you understand a little bit about the difference between in the money and out of the money options, and also how to kind of choose an option on the option chain, and also know that the different dates, the options are more expensive the further you go out, and options are very less expensive if there's only 4 days on the option. So if you have any questions, please leave them in the comments section. Thank you for watching, and I will see you in the next video.